Welcome to the deep dive.
Yeah.
This is where we take the source material, you give us all those articles, notes, research papers, and we really dig in to pull out the absolute essential insights for you.
Yep, helping you get smart, fast on the things you're tracking. And sometimes uncovering connections you wouldn't spot just scanning things yourself.
Exactly. So for this deep dive, you've given us a whole stack of material focused on Edible Garden AG Incorporated. Ticker is EDBL.
Right. And our mission, as always, is to navigate all this information you sent over, figure out what's truly important about EDBL, based only on these sources, all dating around May 22nd, 2025.
That's the plan. We've got financials, press releases, market data, industry stuff. Quite a mix. So let's get into it. We'll cover what the business actually is, who's running it, the financial health, or maybe a lack thereof.
What the market thinks, who owns the shares, and then wrap up with the key risks that jump out from this material.
And stick with us, because towards the end, we're going to highlight something pretty striking we found buried in these sources. A real contrast that, well, it sheds light on their recent, let's say, very active stock performance.
Yeah, it really crystallizes things.
Okay, but before we dive in, just a quick thank you to our partner. If you like what we do here, taking your info and breaking it down like this.
And you want to suggest a ticker? Get your deep dive prioritized.
Then head over to the Stock Analytics AI YouTube channel, hit like, hit subscribe. For just €4.99 a month, members get priority analysis when they suggest a ticker using their source material.
Links in the description, along with info on the kinds of sources we're digging into today.
Okay, Edible Garden AG. Let's unpack it. Chapter 1, what is this business?
All right, so at its heart, Edible Garden is in controlled environment agriculture, CEA. They use, well, the sources call it a hybrid approach. So greenhouses, but also hydroponics, vertical farming, kind of a mix.
And originally they were selling fresh stuff.
Yeah, mostly USDA-certified organic herbs and lettuces. That was the core historically.
But I see a lot in here about a big change, a pivot.
Oh yeah, that's a huge theme in these documents. They're making a really significant strategic shift toward consumer packaged goods, CPGs.
CPGs, like sauces and things.
Exactly. They call it their farm-to-formulae model. It's a big move.
Why do that? Seems like a totally different business than selling fresh greens.
It absolutely is. And the sources are pretty clear. It's about margins. They're trying to get away from, the lower margin fresh produce world, super competitive, stuff goes bad quickly,
Right.
and move towards potentially higher margin packaged goods, things with a brand, longer shelf life.
So what kind of products are we talking about?
Well, there's pulpy sauces, vitamin whey, and whey protein powders, Kick, sports nutrition.
Kick? They just launched that on Amazon, didn't they?
They did, yeah. That's their e-commerce push. Then there's Pickle Party, squeezables or pastes. It's about using that farm connection to build brands for these other categories.
Okay, so they're still growing things, but the focus is shifting to making and selling products from that base. How do they actually operate this?
It's hybrid there too, actually. They have their own facilities, New Jersey, Michigan, but they also use a network of contract growers.
Pros and cons to that, I guess.
For sure. The sources mention it gives them flexibility. Maybe it helps scale faster. But, consistency and quality, managing costs across different partners, those are the challenges.
And sustainability seems really core to their message. Zero waste and spa.
Yeah, they push that hard. It's central to their mission, their value prop. Sustainable packaging, saving water, minimal chemicals.
Which lines up with consumer trends.
And totally. And retailer goals, too, with
Yeah.
ESG targets and all that. It could be a real advantage, if they can really deliver on it consistently.
Any special tech involved?
They mentioned some proprietary stuff, Green Thumb software for managing the greenhouses. And they also talk about these self-watering displays they put in stores, trying to keep the products fresher for longer right there on the shelf.
Okay, let's shift gears. Chapter 2, market position and scale. The sources say they're in thousands of stores, but then the market cap numbers look, well, kind of small. What's the real picture?
Yeah, this is where you see one of those interesting contrasts. The sources definitely state distribution to over 5,000 retail stores. U.S., Caribbean, South America, even mentions potential big names like Walmart in the context of sustainability programs.
5,000 stores. That sounds massive.
It does, doesn't it? But then you look at the market cap figures floating around mid-May 2025. Some sources had it really low, like $2.4 to $3.3 million.
Wow.
If you take the Stark price from May 21st, which is around $4.99, and the share count they reported, about 1.43 million shares, you get a market cap around $7.17 million.
$7 million.
Yeah.
For a company in 5,000 stores, that feels disproportionate,
Yeah.
really low for that kind of reach.
Exactly, and that's a key insight right there from the material you gave us. It tells you they aren't some huge supplier dominating shelf space in those 5,000 locations.
More like a tiny presence in each store.
Precisely. It strongly suggests they're a very niche player, maybe just one or two products per store, really low sales volume per location. That big store count number is more about like potential distribution than current massive sales volume within those stores.
Got it. And there was something about NASDAQ compliance. They had issues.
They did.
Hmm.
They managed to get back into compliance with the minimum bid price rule in April 2025. That's good. Keeps them listed.
How'd they do that?
Primarily through a reverse stock split, according to the sources, which, works for compliance, but needing one often signals the stock price had fallen significantly beforehand.
Right. Usually not a great sign on its own.
And the material also notes they've had a history of seeking approval for multiple reverse splits and increases in authorized shares. That pattern kind of suggests a recurring need for tools that can dilute existing shareholders.
Okay. Chapter 3. Value proposition. What's the promise they're making?
Their main tagline seems to be simply local, simply fresh, simply sustainable. That's the core promise.
And how do they break that down?
Well, locally grown for freshness and lower carbon footprint. Freshness and quality from the controlled environment growing. Sustainability through the zero waste stuff, packaging, water use. Safety and traceability using their tech. And innovation with the new CPG lines under a kind of better for you banner.
Sounds like it hits all the current buzzwords in food.
It really does. Taps right into health, wellness, people wanting to know where their food comes from, environmental concerns, all that.
What's the big challenge for them in actually delivering on that, especially now with the CPGs?
I think it's taking that brand equity they built around fresh, local, sustainable produce and making it stick to things like, protein powder or sauces.
Right. Does it feel authentic?
Exactly. Consumers have to buy into that connection. And then the really big challenge is executing all this profitably and building trust against, a lot of competition, both in produce and now in packaged goods.
Okay, let's talk about that competition and the broader market.
Yeah.
Chapter 4. Industry analysis. How's the CEA and vertical farming space doing overall?
Oh, the trends look really strong based on your sources. The overall CEA market, projected for major growth. Think roughly doubling from around $90 billion to over $175 billion by 2029. That's like a 14% plus compound annual growth rate.
Wow, okay. And vertical farming specifically?
Even faster growth, actually. Projected to more than double, too, from about $7.7 billion to over $21 billion by 2029. That's a CAGR north of 21%.
Those are huge growth rates. What's driving it all?
A few big things. More people living in cities, urbanization, concerns about food security, consumers demanding fresh, local, organic stuff year-round. Water scarcity is a factor, too. Plus all the tech advancements in lighting, automation, hydroponics. It's a sector with some serious tailwinds.
But fast growth usually means lots of players jumping in, right?
Competition.
Oh, fierce competition, yeah. The sources mention big, well-funded companies like Siemens, Bowery Farming, Infarm, Aero Farms, Bright Farms.
Big names. Right. So the insight here is you've got Edible Garden with its, single-digit million-dollar market cap trying to compete for shelf space, talent, innovation against companies that might have hundreds of millions or even billions behind them.
And they're competing on multiple fronts now.
Exactly. They're still up against traditional farms for fresh produce prices, and now they're taking on giant established food companies with these new CPG lines. It's a tough spot, competitively speaking.
What about regulations? And I saw mention of the 2025 U.S. tariffs. How does that play in?
Yeah, the sources flag tariffs as a real wild card. They're projected to bump up consumer prices overall, including food, like 2.3% for food generally, maybe 3% specifically for fresh produce.
And for EDBL's costs.
Tariffs hit inputs, right? Things like fertilizers, steel for greenhouses, electronic components, especially if sourced from places like China or Mexico. So that increases their costs for building things, expanding, and just day-to-day operations.
Squeezing margins further.
Potentially, yeah. Or they have to try and pass those costs on. The interesting angle is, while their local growing might avoid some global shipping costs, a lot of that high-tech CEA gear still comes from international suppliers.
Is there any upside?
Well, maybe. The sources suggest a complex dynamic. If tariffs make conventional, imported produce significantly more expensive.
Maybe CEA stuff looks more competitive on price.
Potentially, yeah. If EDBL can manage its own cost increases from tariffs effectively, It's tricky. The sources also mentioned temporary tariff truces, but also closing that de minimis loophole, which adds fees to small international packages. So it's messy.
Are there big hurdles to even getting into this business? Barriers to entry?
Absolutely. You need a lot of capital up front for the buildings, the tech. You need specialized know-how. Getting into stores and building a brand is tough. And energy costs for indoor farming can be really high.
So even though EDBL is already operating, these are ongoing challenges for them too.
Definitely. Their constant need for cash to fund everything means those same barriers make it hard for them to scale up quickly and really challenge the bigger, better-funded players.
But overall, the long-term future for the CEA industry looks good, according to these sources.
Yes, the consensus seems to be strong, driven by those big fundamental trends like urbanization and sustainability. The industry itself seems promising.
Okay, Chapter 5, Management. Who's running the show?
The main person is Jim Cross. He's the CEO and chairman. He's listed as a founder, took them through the IPO, and importantly, given their big strategy shift.
The CPG pivot.
Right. He actually has a background in CPG marketing, worked at places like Nature's Bounty, Ajinomoto. So his experience seems, pretty relevant to where they're trying to go now. Been CEO for about 5 years.
What's their track record look like under him? What have they actually done?
Well, they've definitely made moves. Executing that CPG pivot is the big one. They strategically got out of some lower margin lines.
Which hurt revenue short term. We saw that.
Exactly. But the sources say it helped gross profit and gross margins improve. They've also done some M&A, recently bought assets from natural shrimp water treatment patents, things like that, funded it with preferred stock.
Okay. And there was another potential deal mentioned, Narayan Group.
Yeah, they were proposing to acquire Narayan Group. The company described it as potentially transformative, maybe for global expansion.
But you said that one was under investigation.
Correct. A law firm is looking into that proposed deal on behalf of shareholders, questioning if the terms were fair, if disclosures were adequate. It's just an investigation at this stage, but it definitely raises a question mark about that specific transaction and shareholder interests.
How have they handled tough situations, like the NASDAQ compliance issue?
Well, they did fix it, which shows they can address critical problems. But again, the way they fixed it, needing that reverse split and the history of needing more shares and splits, it points to using tools that dilute shareholders to sort of, navigate financial difficulties.
How are they on transparency?
They use the standard channels, press releases, filings, calls. But the most critical piece of transparency, honestly, is probably that going concern language in their 2024 annual report, the 10K.
What does going concern mean exactly?
It means the company itself, in its official filing, is stating there's substantial doubt about its ability to continue operating as a business for the foreseeable future. That's about as transparent as you can get about serious financial fragility.
Wow.
The M&A investigation adds a layer of scrutiny, sure, but that going concern is a direct warning from management itself.
What about their ethical reputation? They really lean into the sustainability angle.
They do. They've built a public image around being green and ethical, zero waste, organic certs, joining Walmart's Project Gigaton, research partnerships, food bank support, working with Chef J.J. Johnson. It seems like a real focus for their brand. But that shareholder investigation into the fairness of the Narayan deal does introduce a potential question mark, specifically around how they handled that proposed transaction.
Okay, so let's synthesize this. Based on these sources, are they honest, capable, shareholder-oriented?
It's definitely a mixed bag, honest. Well, disclosing the going concern is pretty candid, you could argue. But the M&A investigation raises questions about fairness in that deal. Capable. The CEO's background fits the strategy, and they fixed the NASDAQ listing. But the ongoing losses and cash burn make you question their ability to execute this huge pivot profitably.
And shareholder-oriented.
Again, mixed. Keeping the NASDAQ listing is good for shareholders, provides liquidity, but the pattern of dilution through financing, the warrant deals at lower prices, CEO pay versus company performance, and that M&A fairness question. It doesn't paint a clear picture of always putting shareholder value per share first.
Got it. Chapter 6. Capital allocation. Where's the money going? Assuming they have any.
Right. Well, the sources indicate key investments are going into getting their Heartland facility fully up and running, trying to bring more production in-house, control costs, also R&D, like those nanobubble trials for irrigation, and the water patents they just bought from Natural Shrimp fit there, too.
And the CPGs.
Oh, yeah. A lot of capital is going into developing, launching, and marketing those new product lines. That's the core strategy right now.
What about the M&A stuff, the Natural Shrimp deal?
That was a $15.5 million deal, but funded entirely with preferred stock. So it avoided adding debt, but it means they had to find investors willing to take that preferred equity instead of cash. The proposed Narayan deal was framed as being for diversification and global reach, but the details on funding and terms are less clear in these sources, plus there's that investigation cloud.
Are they giving any cash back to shareholders? Buybacks? Dividends?
Nope. Sources say neither, which makes sense, right? They're not profitable, they're burning cash, they need every penny for operations and growth. Returning capital isn't really on the table.
What about return on invested capital, ROIC?
Well, specific numbers aren't given, but based on the consistent net losses and negative operating income, the ROIC is definitely negative. The key point is the capital they are deploying isn't generating positive returns yet, it's being used up by losses. They need to get profitable first before ROIC can even turn positive.
So are they actually using capital effectively to grow shareholder value today?
Based on the huge share price decline over the past year and the ongoing losses, no, the historical record doesn't show effective capital allocation for shareholder value. The current strategy, the pivot, the acquisitions, these are attempts to change that. But they're funded largely by dilutive means, and whether they'll actually lead to sustainable profits, well, that's still unproven based on the financials presented here.
Okay, let's get deeper into those financials. Chapter 7. Financial analysis. What story do the numbers tell?
All right, using mostly the Q1 2025 and full year 2024 data here, market cap, like we discussed, around $7 million recently. Definitely microcap territory, high risk, low liquidity, lots of volatility. PE ratio, meaningless basically because of the losses.
Revenue trends, we touched on this. Down overall.
Yeah, Q1 revenue down 13.2% year over year, about $2.7 million. Full year 2024 was down 1.4% to $13.86 million. But again, the key insight from the sources is that this was largely planned, getting rid of lower margin stuff.
Right, the strategic exit.
Exactly. And the stuff they are focusing on, the non-perishable CPGs, that revenue actually grew 15% in Q1. Cut herbs were up 13% too. So the core areas are showing some growth, even as the total shrinks during this transition.
Makes sense. Okay, what about profit margins? Especially gross margin.
This is where they've shown some improvement, but context is key. Full year 2024 gross margin jumped to 16.7% from just 5.9% the year before. That's a good percentage jump.
That's good.
But Q1 2025 gross margin was only 3.2%. Now that's better than the 0.7% it was the prior Q1, but the insight is 3.2% is still really low, like extremely low, especially when their stated target is 35-40%.
Wow, yeah. Miles away.
Miles.
And below the gross profit line, it gets worse. Operating margins, net margins deeply negative. Q1 operating margin was negative 108%, net margin negative 122%. Full year 2024 wasn't much better, negative 67% operating, negative 80% net.
So nowhere near profitability.
Not even close. High operating costs, SG&A is a big one, plus significant interest payments are just eating up any gross profit and driving big net losses. We're talking a $3.3 million loss in Q1 alone, $11.1 million loss for all of 2024. They need massive margin improvement and revenue growth, or huge cost cuts, or both.
What about debt? Debt to equity?
As of the end of Q1 25, total debt was about $2 million against equity of roughly $1.9 million. So the DE ratio is just over 1, around 1.07.
So creditors have slightly more claim than shareholders.
Yeah. The main issue isn't the absolute amount of debt. $2 million isn't huge in itself. It's the debt relative to that tiny equity base, the ongoing losses, the negative cash flow. They had to pay almost $500,000 in interest in Q1. That's tough when the business isn't generating cash.
Right. Which brings us to free cash flow. Are they generating any cash?
Doesn't look like it. The sources don't give a full FCF calculation, but they clearly show the company burning through cash. Cash balance dropped by over $3 million just in Q1 2025. One source estimated they burned through almost $9 million in cash for the full year 2024 on an FCF basis.
So they need outside money just to keep the lights on.
Essentially, yes. They're relying on financing, not cash from operations, to cover expenses, pay debt, and fund that CPG strategy.
Okay. Price to book.
Using that recent $4.99 price and the Q1 book value per share of about $1.34, you get a PB around 3.74. Some older figures in the sources were way lower, like 0.7 or 0.8, but that was when the stock price was much lower too.
So 3.74, not exactly screaming undervalued based on book, especially with negative earnings.
No, not really. Especially for a company losing money and with negative return on equity. Book value isn't the main story here.
So pulling the financial stability thread together, what's the bottom line?
Honestly, this is where the sources paint the most concerning picture. Earnings aren't just up and down, they're consistently negative. No dividends. Debt isn't being paid down from profits. It's managed through more financing deals, like those warrant exercises or merchant cash advances, which can be expensive and dilutive.
On working capital?
Negative at the end of Q1, about negative $1 million, meaning their short-term debts exceeded their liquid assets. That points to real liquidity pressure.
And then there's the big one.
The going concern language. Right from their own 10K filing for 2024. Management explicitly stating substantial doubt about their ability to continue. That's pretty serious.
So if we ask, are earnings volatile and is debt excessive?
The earnings are consistently negative, not really volatile in a good way. And the debt, while maybe not excessive in pure dollar terms, looks very risky relative to everything else. The losses, the cash burn, the weak balance sheet, that going concern warning. They need external cash constantly, and that's driving dilution.
Okay. Chapter 8, market sentiment. How's the stock market reacting to all this?
Well, the main theme is extreme volatility. The sources mention a high beta, meaning the stock swings way more wildly than the overall market. And looking back over the past year leading up to mid-May 25, it was brutal. Massive value destruction, stock down something like 98%.
Ouch. But then, that crazy surge recently.
Yeah, this is where it gets wild. And just a couple of weeks before May 21st, the stock just exploded upwards. Like over 116% gains in 2 weeks, some days with absolutely enormous percentage jumps.
What on earth caused that? After a 98% drop?
The sources point directly to a cluster of news releases hitting around the same time.
Ah, okay. Like what?
The Q1 results, even though still loss-making, they showed that gross profit improvement and progress on the CPG shift. Then the natural shrimp asset deal, getting those patents, the Kiki sports drink launch on Amazon, and getting back into NASDAQ compliance.
So a string of positive-sounding news items.
Exactly. Released close together. It looks like that combination just ignited a frenzy of speculative buying in what's a very low-flowed microcap stock.
Makes sense. What do analysts think? Any price targets?
Coverage is thin, which is typical for stocks this small. One source cited an average one-year target around $8.16 in mid-May. Pretty tight range. But the real insight isn't the target itself, it's how much the targets have jumped around.
Oh.
Yeah, over the past year, targets mentioned swung from like 50 cents to over $12, then back down to 8. It just shows how uncertain even the analysts are trying to value this thing amidst all the volatility and strategic shifts. There was one analyst with a strong buy rating noted.
What about short sellers? Are people betting against it?
Short interest percentage wasn't super high, maybe 3.5% to 4.5% of the float. Days to cover were low, too. So not a huge crowd shorting it by volume.
Right.
But the cost to borrow shares to short was really high, cited over 30%. That's significant.
What is a high borrow rate usually?
It means either there's strong demand to short the stock, or it's just really hard to find shares available to borrow. Often happens in highly volatile, speculative situations. Could suggest conditions ripe for a short squeeze, even if the overall short float isn't huge. Options activity likely plays a role, too, though specifics weren't detailed.
Okay, Chapter 9. Ownership. Who actually holds the shares? Institutions. Insiders.
Institutional ownership is really low, like tiny. Sources cited numbers between 0.25% and 3.5%. Only about 10 or 13 institutions holding any shares, and mostly small positions. Think firms like Tower Research, SBI Securities, UBS, Fidelity.
So not attracting big money managers.
Not really. And the critical insight here is that institutions have actually been selling. The sources show formerly larger holders, names like Armistice Capital, Dominion Capital, Riverside Merchant Partners, significantly cut their stakes or got out completely in late 2024 or early 2025.
That sounds like a lack of confidence from the institutional side.
It definitely points that way, yeah. A clear trend of selling down based on this info.
What about insiders? Management owning shares.
Overall, insider ownership is also pretty small, around 3.5%. The CEO, Jim Craze, owns less than 1% directly. Although it is worth noting the sources mention he did make some open market purchases back in November 2024. The stock price was really low then, like 17 cents. So even though the dollar amount wasn't huge, it could be seen as a small sign of confidence from the top. Other directors seem to hold a very little.
And didn't they just do that deal with an institutional investor involving warrants?
Yes, that was big news around May 21st. An induced warrant exercise. Basically, an existing institutional holder exercised warrants they already had,
Okay.
but they did it at a reduced price, $3.50 per share instead of the original $9 exercise price.
Why would the company agree to that?
To get cash quickly. The deal brought in about $3.5 million gross for Edible Garden, but the trade-off was, in exchange, the company issued new warrants to that same investor.
More warrants.
Yeah, new 5-year warrants for potentially up to almost 2 million more shares, also exercisable at $3.50.
So they got cash now, but created potential future dilution at a pretty low price.
Exactly. It's a way to raise capital fast, but it comes at the cost of potentially watering down existing shareholders later on. It definitely signals an urgent need for cash.
Is ownership concentrated anywhere now?
Doesn't seem like it based on these sources, especially after those larger institutions sold off. It looks fairly dispersed between the remaining small institutions, insiders, and the general public flow.
All right. Chapter 10, Risk Assessment. Let's pull all the threads together. What are the biggest risks facing EDBL based only on this source material?
Okay, let's break it down. First, the financial risks are just stark. You've got the persistent losses, the constant cash burn.
The negative working capital.
Right, negative working capital, serious liquidity pressure, meaning trouble meeting short-term bills. The debt isn't huge, but it's a burden when you have no operating cash flow. This forces them into that cycle of external financing, leading to dilution reverse splits, those warrant deals.
And the going concern warning.
Can't forget that. It underlies all the financial risk. Then you have massive execution risks.
Making the CPG pivot actually work.
Exactly. Can they really succeed in these super competitive CPG markets against giants? Can they actually hit those 35–40% gross margins they're targeting? Can they integrate the natural shrimp patents effectively? Can they manage quality and costs with that hybrid grower model? Lots of ifs.
Accurate.
Intense competition, like we said. For shelf space, for consumer eyeballs, both in produce and CPGs. They're sensitive to consumer spending changes, price wars. The whole CEA market is volatile. And can they keep up technologically with bigger players?
External factor.
Those 2025 tariffs hitting their costs, the uncertainty around that Narayan merger investigation, and just the constant need to comply with strict food safety and organic rules.
And finally, brand risks.
Yeah, moving into things like protein powder. Does that dilute the core fresh, sustainable image they built with herbs? If consumers don't see it as authentic, that's a problem. And any operational slip-ups or negative investigation outcomes could hurt their reputation.
Okay, so Chapter 11, Conclusion. Bringing it all home. What's the final picture of Edible Garden AG based solely on the sources you provided us?
Well, it's a picture of a small microcap company playing in some potentially high-growth areas, like CEA. They're making a very clear, ambitious, strategic shift into CPGs, hoping for better profitability. And they have had some recent positive news flow, improving gross margins, the asset acquisition, new launches, fixing the NASDAQ issue.
That's at the positive side.
That's the positive spin. But the sources also paint a really clear and, frankly, concerning picture of the underlying fundamentals. Persistent, large losses, negative cash flow, a weak balance sheet, negative working capital, a history of needing dilutive financing just to keep going, intense competition.
And topped off by the going concern language.
Exactly. That looms over everything.
So what are the key takeaways for you, our listener, looking at this specific information stack?
I think it shows you a few things really clearly. How a big strategic pivot can look positive on the surface but cause financial strain, like falling revenue initially. It highlights the brutal competition small companies face. It underscores the extreme risks and volatility you often see with microcap stocks.
And that disconnect between news and fundamentals.
Absolutely. It perfectly illustrates how a burst of news, even against a backdrop of serious financial wreckness, can trigger massive speculative swings in a stock price.
Which brings us right to that hook we mentioned at the start. The most striking insight from digging into all this material.
For me, it's that stark, almost jarring contrast. On one hand, you have the company's own filings explicitly stating substantial doubt about its ability to continue operations because of losses and cash burn. That's the documented financial reality.
And on the other hand,
you have this sudden, dramatic, triple-digit percentage surge in the stock price, seemingly fueled entirely by recent news and speculation. That powerful tension between the stated financial fragility and the market's recent speculative excitement, that, I think, is the core insight these sources reveal.
That is a really sharp contrast. Definitely ties it all together. So the final provocative thought for our listener to chew on, based on all this.
Yeah, maybe something like this. Can a company that has documented negative working capital, limited cash, a formal going concern warning, and a track record of relying on dilutive financing, can it realistically fund and execute multiple complex, capital-intensive growth strategies all at once? Integrating acquisitions, launching diverse CPGs, competing against giants. Can they do?
You've seen in these sources.
We really do appreciate you sending over the material that allowed us to do this deep dive today.
Yeah, absolutely. And hey, if you want more deep dives like this, maybe based on your research or a ticker you're following, make sure you subscribe to the Stock Analytics AI YouTube channel.
And don't forget that Euro $4.99 a month membership gets your suggested ticker prioritized for analysis like this. Check the link.
And just the standard but very important reminder, this deep dive was put together using only the source materials you provided. We use AI assistants to help structure and clarify, but the content is based strictly on those documents.
Yeah, this is absolutely not financial or investment advice. It's purely for informational and educational purposes based on the stack you gave us.
Definitely do your own independent research. Talk to a qualified financial advisor before making any investment decisions. Seriously.
Thanks for joining us on the deep dive.